Right now, somewhere in a data center, there's a number assigned to you that you've never seen. It's not your credit score. It's worse than that, because you can't even argue with it. This number decides whether you get a job, whether your insurance costs $50 a month or $300, whether you can rent an apartment, whether the bank charges you 4% interest or 12%. And here's the thing, most people don't know these scores exist at all. You probably know about your FICO score. You check it on your phone, you panic, then you forget about it. But FICO is just the popular kid in a much larger class. Behind the scenes, there are dozens of hidden credit scores that are actively making your life more expensive every single day. This isn't conspiracy thinking. This is how the system actually works. Today, we're pulling back the curtain on what these scores are, how they get built, and what they're doing to your wallet without your permission. Why this matters now. Credit scores exist because lending is fundamentally a bet. A bank has money, you need money. The bank says, I need insurance on that bet. That insurance is called interest. The amount you pay depends entirely on how risky the bank thinks you are. For decades, credit scores made sense. They measured behavior. Did you pay bills on time? How much debt are you carrying? It was logical, almost fair. But 15 years ago, the lending industry realized something. Traditional credit scores only tell part of the story. They don't measure everything that predicts whether you'll be a good risk. So they got creative. Now you don't just have one number determining your financial life. You have dozens. Some measure things you've done, some measure things you haven't done, some measure things that have nothing to do with you but happen to correlate with default patterns. Half of these scores are invisible to you. Why does this matter right now? Because the credit industry is more sophisticated than ever. Machine learning can predict financial behavior with unsettling accuracy. As these models get better and widely adopted, the gap between people with good hidden scores and bad hidden scores is going to widen dramatically. The person with a hidden score of 750 and the person with a hidden score of 600 might walk into the same bank, apply for the same loan. One walks out approved, one walks out rejected. Or approved but at a rate that costs them tens of thousands of dollars over the life of the loan. That's the difference between being able to afford home ownership and being priced out forever. Breakdown: the landscape of hidden scores. Let's map out what actually exists, because the ecosystem is genuinely complicated. First, alternative credit scores. These are built by the same companies that build your FICO score, Equifax, Experian, TransUnion, but designed for lenders who want something different. Lenders who want to approve people that FICO would reject, or lenders who want to charge riskier people more money. Equifax alone has over 3,000 different credit scores. Not versions, different scores entirely. Some measure whether you'll default in the next 90 days. Some measure whether you'll miss a payment in the next 12 months. Some are industry-specific, one for auto lending, one for mortgages, one for credit cards. A bank might pull 5 different credit scores on you in the same day. You never see any of them. Then there are specialty scores. Clarity Services has a score. LexisNexis has multiple scores. The National Consumer Telecom and Utilities Exchange has scores based on your telecom and utility payments. You probably have an account there. You probably don't remember signing up. And then there are insurance scores. These are built by data brokers using your credit history, claims history, zip code, age, and marital status to produce a number predicting whether you'll file a claim. The worse your insurance score, the more your premiums cost. This is legal. It's standard practice. Your car insurance isn't just based on your driving record. It's based partly on financial behavior that has nothing to do with driving. A person with a bankruptcy from 5 years ago might pay 30 to 40% more for car insurance, not because bankruptcy predicts bad driving, but because bankruptcy predicts people who file claims. It's statistical bias baked into the algorithm. The invisible architecture. Most of these hidden scores aren't built on information you've provided. They're built on information about you. There's something called alternative data. This is data that isn't your traditional credit history. It includes whether you pay utility bills on time, whether you use prepaid debit cards, Whether you use payday loans, your rental payment history, whether you check your credit report regularly. Yes, that's tracked. Some alternative data is bizarre. What you listen to correlates with spending patterns, which correlates with financial reliability. Not directly, but in a machine learning model trained on millions of data points, every signal matters. Companies like Clarity Services collect alternative data on 200 million Americans. LexisNexis has data on over 200 million consumers. eSpeed tracks transaction data. These companies package it for lenders. What's it used for? To identify borrowers the traditional credit scores miss, to identify people who look risky but might be fine. More importantly, to identify people who look fine but might actually be risky. If a lender can identify people who will default before they even know they're going to default, the lender can price them accordingly, charge them 2% more. Over 30 years on a mortgage, that's hundreds of thousands of dollars. The uncomfortable math. The difference between a credit score of 620 and 760 on a $300,000 mortgage costs you about $200,000 in interest over 30 years. Now imagine a hidden score that moves you from the middle of the risk pool to the upper end. Imagine that score is built on alternative data you don't know you're generating. A 2019 Federal Reserve study found that people in the lowest credit score quartile were paying an average of 1.5% more on mortgages than people in the highest quartile. On a $300,000 loan over 30 years, 1.5% more costs you about $100,000. But here's the darker part. People in the lowest quartile had higher denial rates. They were 200% more likely to be denied for a mortgage. You're not just paying more, you're being priced out. Now add hidden scores. A lender might have access to alternative data showing you're risky even though your traditional credit score says you're fine. They charge you more. Maybe they deny you entirely. Maybe they approve you for a smaller loan. In auto lending, subprime lenders use sophisticated scoring models to identify someone likely to default. People with subprime auto loans pay rates of 15 to 20% for a used car. Prime borrowers pay 6 to 8%. That's not just expensive, that's a financial trap. The feedback loop. If you have a bad hidden score, you get charged more money. That extra cost reduces what you can save, or you can't afford it, so you default. If you default, your actual credit score goes down. Your hidden scores go down too. The hidden score predicts behavior. You get charged more because of the prediction. That charge makes the prediction more likely to come true. You default. The hidden score was right. It's a self-fulfilling prophecy. A lender can identify someone, charge them a rate that makes it harder to pay, and collect interest on money that would have gone to their mortgage or kids' education or retirement. This isn't conspiracy. This is business. It's legal.
The contrast. What you think versus what's actually happening. Most people think you build a score. The score determines your rate. You get approved or rejected. Clean, logical. You have agency. What's actually happening? You generate data constantly. Payments, purchases, inquiries, alternative data. That gets collected and scored by companies you've never heard of using models you don't understand. Those scores determine whether lenders will look at you. If they do, those scores determine your rate. If your rate is high enough, you can't afford the payment, so you default. That creates new data, which lowers all your scores, which makes it harder to borrow, which pushes you toward payday loans, and eventually makes it impossible to afford basic things like a car or house. The system isn't just invisible, it's designed to be invisible, because transparency would be expensive and politically difficult. If lenders had to tell you your hidden scores, you challenge them. That's expensive and time-consuming. But the invisibility is the whole point. If a lender can charge you more without you knowing why, there's no friction. You attribute it to something vague, the economy is bad, rather than to a hidden score you've never heard of. The hidden variables. Certain behaviors are heavily correlated with being wealthy. Having multiple credit accounts, paying them down regularly, never missing a payment. All of these things correlate with wealth because wealthy people can afford to do them. But alternative scoring models don't distinguish between cause and effect. They just see patterns. A model identifies that people who maintain multiple accounts are lower risk. That's true, but why? Not because maintaining accounts is inherently responsible, because you can't maintain accounts if you don't have money. Now imagine a model that includes what you buy, what stores you shop at, what restaurants you eat at. A machine learning model could identify that people who shop at certain stores are lower risk because those are the stores wealthy people shop at. This is called proxying, a form of discrimination. It's legal because the algorithm doesn't explicitly use protected characteristics like race or income. It just uses shopping patterns that happen to correlate with them. The FTC has gone after companies for this. In 2022, it ordered Equifax to pay $700 million for using alternative data that discriminated against people without their knowing it. The alternative data industry is still massive and largely unregulated. The information asymmetry. You probably know one of your credit scores. You might pay $15 a month to check it. You know that late payments hurt, high utilization hurts, but you don't know your hidden scores. You don't know how many exist. You don't know what data they're built on. You don't know how much they're costing you. The lender knows all of this. The lender knows your hidden scores probably better than you know your actual scores. The lender knows exactly how much you should be charged. The lender then negotiates using information you don't have. This isn't capitalism. Capitalism requires information symmetry. If a lender charges you 8% because of a hidden score you don't know about, there was never really a negotiation. There was just a lender taking advantage of you. The lender isn't breaking rules. There's no law saying lenders have to tell you why they rejected you or why they charged a particular rate. The reason given is usually vague. Credit score too low. Not your hidden employment stability score is 450. The stakes, where this is going. For most of history, credit was a relationship. A banker knew you. They made a judgment call. Then credit became automated. Credit scores meant evaluation by formula instead of judgment. That was supposedly more objective, more fair. But objectivity is a trap when the formula is invisible and the data is deliberately obscured. Now we're entering predictive lending. Lenders will know you're going to default before you do. They'll charge you accordingly. If they're right, they make money off you. If they're wrong, they've still charged you for the risk. The business model? Identify people you think will have financial trouble, charge them enough to cover that trouble, and watch them have financial trouble because they're now carrying more debt at higher rates. It's unethical. It's also stable. It perpetuates itself. It creates a permanent underclass, always a paycheck from disaster, because the credit system has already identified them as high risk. The wealthy person gets cheap credit, builds wealth, maintains good scores. The poor person gets expensive credit, loses wealth, gets worse scores. The gap widens. Zoom out. The bigger picture. This isn't unique to credit. Insurance companies use identical techniques. Your car insurance depends on hidden risk scores from alternative data. Your health insurance might too. Job applicants are screened by predictive models built on alternative data. Landlords use risk assessments built on credit scores and everything else. A person rejected for an apartment doesn't just lose it. They move somewhere more expensive or less safe, which affects job prospects and earning ability, which affects credit. The whole system is interconnected. Your hidden scores in one realm affect opportunities in another. The financial system, housing market, job market, they all get information from the same data brokers. They all use hidden scoring models you can't see. This is the infrastructure of inequity running on data. Here's the question we're left with. If you can't see the scores that determine how expensive your life is, can you ever actually control your finances? You can optimize your credit score, make on-time payments, keep utilization low, do everything right. Your FICO will be pristine. But somewhere in Equifax's servers, LexisNexis's data centers, a dozen other companies' machine learning models, there's a hidden score running your financial life, and you have no way to see it or change it. You can't dispute what you can't see. You can't improve what you can't measure. The people who built the credit system will tell you it's meritocratic. Work hard, pay your bills, build your score, get better rates. They're not lying. That does work for some people. But they're leaving out the part where some people's hidden scores start at 400 because of where they live or what data they're generating without knowing it. The game was rigged before you ever sat down to play. Maybe the question we should ask is, what would it take to build a credit system that's actually fair? One where scores are visible, one where data is auditable, one where you know exactly why you're being charged what you're being charged. Right now, we have a credit system optimized for lenders, not people. What would change if everyone knew?